Okay, right. Well, let's get into some of the content, and I'm sure more people will join. We've got just under 30 now, with just over 60 registered, so I'm sure more people will join us as we go on. Thank you everybody for joining the webinar today. The topic of the webinar is how to create passive income through property investment, and there's a few key focuses of this talk. Part of it is how to take proactively made income or profits. So whether you're an employee earning enough money to save and put money away and you want to better utilize it, or whether you're a business owner generating profits and want to better utilize those profits, property investment as a mid to long-term strategy can work really well so far as better utilizing that money, taking some leverage, getting a really good return on the funds, and building a portfolio which essentially creates a whole second business alongside you, whether it be your job or your other business, quite passively, to enable you to work toward generating a certain level of income at some point in the future. And I suppose just to introduce myself for those that don't know me, I'm Paul Mahoney. I'm the founder and managing director at Nova Financial Group, and we're a property investment advisory company. So we advise on pretty well all aspects of investing in property, from helping clients better understand their current situation and their goals. So, what's point A, what's point B, and how are you actually going to get there so far as implementing a strategy. Then the research and due diligence that goes into sourcing the right properties specific to that person's situation, financing them, managing them, and then helping our clients review and reinvest when it makes sense to do so, so they can actually work toward their end goals and build a portfolio. So in a nutshell, that's what we do as a business. We help take the guesswork away from what, property investment in the past has been quite a do-it-yourself activity, but there's been lots of changes of late, things like Section 24, stamp duty premiums, mortgage serviceability. Also, for example, London, the southeast, very much slowing down from a capital growth perspective and more difficult to get finance. There's been change. I suppose there's a bigger gap now between what works in the current market and what doesn't. And therefore, you really want to make sure that you're making the right decisions and that you are best utilizing your money to actually work toward your goals. And that's really what we specialize in assisting our clients with. Excellent. We've got our first question in the question and answers section. So as I mentioned, guys, any questions that you have on your mind now or that might come up throughout the discussion or throughout the webinar, please plug them into the questions and answers section, and I'll come back to them toward the end and answer them, hopefully to the best of my ability. And anything that is more complicated, we can obviously come back to. But I should be able to answer most of the questions relatively well, I think. Good. Okay, guys. Well, let's. I'll get into some of the content now. What I like to do is toggle back and forth between the content and sort of having a little bit of a discussion with everybody. But one thing that I do always like to do in my seminars is to get a bit of a read of the room, essentially who I'm talking to and the level of experience in the room. So if I can turn your attention to the Zoom webinar chat function now, and if everybody could just tell me whether you're a beginner, an intermediate investor, or a more experienced investor. If you don't mind just commenting I believe it's only me that can see you anyway. Okay. A few beginners, a few intermediate. Okay. A bit of a mix. Okay. It's always good for me to know who I'm talking to. And as I say, I like to make these as interactive as possible. Okay, work through development here. It's okay. So some people are beginners, others have a bit more experience. And can I just ask another question? What are the main things that those participating in the webinar today would like to get out of the webinar? Essentially what I'm asking is, what are the main things that you would like to achieve from the talk today, so I can try to tailor it a little bit toward what people want? understand our services. Okay, excellent. We'll definitely cover that. When to take the first step in property investment, stable and hassle-free returns. Okay. When it makes sense to invest in property or use savings another way. New tax implications. We won't cover the new tax implications in detail today, but more than happy to cover that on a sort of one-to-one basis or with one of our advisors. Growth strategies. Okay, tax efficiency. All right, a bit of a spread there, so I'll try to cover as much of that as I can throughout the talk. What I'll do now is I'll share my screen with you all and start going through some of the content, and then I'll come back and again, as I say, try to make it as interactive as we can as I go. Right. So, sharing my screen with you all now. And I'll just get through a few slides. So, as I mentioned, the topic of the talk today is how to passively build a property portfolio so you don't have to work forever. Bit of a disclaimer to start with. So we are a regulated business. So it's important for me to say that anything that I do cover in the talk today is quite general in nature. It's not specific to you, and you shouldn't necessarily act upon it. You should seek personal advice before making any changes to your finances or your investments. And that's something that we can help you with on a one-to-one basis. So we will cover quite a lot, especially between the slides and also the question and answer section. There'll be quite a lot of detail we'll go through. So we feel a little bit like this guy drinking from a fire hose or a fire hydrant. Don't worry too much, because we will also be offering one-to-one consultations following the webinar, where we can answer your questions in a lot more detail, very specific to your situation. So they will be free face-to-face video conferences, given what we usually do face-to-face, but via video conference, given our current situation, given COVID-19. Right, so agenda for the talk. I'll start off by introducing Nova in a little bit more detail so that you understand the direction from which we're approaching this. I'll cover why leverage property and why we like leverage property so much for such a broad range of people. What your investment options are and what the returns associated with those investment options are. Why buy-to-let for business owners? Now, this isn't just for business owners. It's also quite relevant for those that are employees but have spare funds or a pretty substantial income. How to better utilize that proactively made money and turn it into passive income. What types of property work best for passive investors? The snowball effect, and I'll cover what that is. Essentially, it's how to build a portfolio and how the more properties you acquire, the easier it is to acquire more quicker. How many properties you may need. And then we'll also cover the free consultation and advice offer, which is essentially an incentive or an offer that we're offering as part of the webinar. Okay. So first off, Nova. So Nova Financial Group is essentially the group of companies that I own and operate. We cover pretty well all aspects of property investment, as I mentioned, from helping people understand their current situation, their goals, the best strategy for achieving their goals, sourcing the right properties specific to their situation, financing those properties. So we have an in-house brokerage of which I'm the principal, financing those properties, managing those properties, and then reviewing and reinvesting as time goes on. So essentially helping people better utilize their current resources to invest in property, achieve a good return with a good level of confidence whilst mitigating risk. What makes us different is that we very much approach property from a financial planning perspective. So it's not about, we essentially take all the sales out of property, which unfortunately, the property industry is very sales focused generally. It's about, you go to someone, speak to them about their book or list of properties, and you're not getting anything other than that. Whereas we are completely independent in our approach. So it's very much specific to your situation. Qualification, I've been in the industry for just over a decade. I'm a qualified financial advisor and mortgage advisor. I'm supported by a team with over 100 years of experience. We have about 5 or 6 qualified financial advisors within our team. So we very much approach property investment from a financial perspective, so far as understanding why we're actually investing in property, which is generally to make money and, excuse me, and achieve financial goals. So we're more goals focused than product focused. We also have very strong relationships throughout the UK property market and a lot of buying power because our clients buy a lot of properties, so we can get our clients the best deal. So that's essentially us in a nutshell and what we help clients with. Why leverage property and why do we like leverage property? Well, I suppose first off, as an example, we can take £50,000 and invest into a £200,000 asset with a 75% mortgage, which means by achieving relatively average returns on the £200,000 asset, we can get really strong returns on our £50,000 deposit. So what I mean by that is, for example, looking at yield, what we would generally aim for in the current market based on current interest rates and current yields available is a net yield on funds applied of between 5 to 10%. So using that same £50,000 example, we'd be getting £2,500 to £5,000 of post-cost pre-tax income. So post all of your expenses, including your debt, your property management, service charges, maintenance, all that sort of thing, that would be our net income post all expenses. And then on the growth side of things, a relatively average 5% return on the asset value, or 5% uplift on the asset value. And keeping in mind that the UK average over the past 20 years, including 2 major recessions, is 5.5% per annum. So 5%, a bit more conservative, on the asset value gives us 20% on our cash. Just to put that another way, just for anyone that isn't a numbers person, 5% uplift on a £200,000 property is £10,000. So that would mean the value of the property is now £210,000, and a £10,000 return on a £50,000 deposit is 20%. Okay, so if we put those two figures together, your 5 to 10 with your 20, you're at 25 to 30% per annum. Now, I think in anybody's opinion, any logical person's opinion, 25 to 30% per annum is a good return. But what's very interesting with leveraged property investment is that we can do that with a relative amount of confidence because we are not setting the world on fire by any stretch of the imagination. What we're doing is achieving relatively average returns on the asset value, which gives us really good returns on our cash. If we're doing much better than the market, then these returns get much better. But we don't necessarily think they need to be. And therefore, we like to invest in the types of properties and locations where we have the most confidence in getting those returns and mitigating the risks of not getting them. So investing in a tangible asset, which is property, it's often made of bricks. It's not going to disappear overnight. It's always going to have some underlying value. But if it's in a good location that's desirable to a large target market, we can be confident that it's always going to rent relatively well and there'll always be a resale market for it, regardless of the economics or political cycles. So in our view, that's what we tend to aim for, and obviously offers a pretty decent return. I'm going to check back with everyone just to make sure you can still hear me okay. Just turn to the chat section. Everyone can still hear me fine. Just want to make sure I don't lose you all halfway and then end up talking to myself for an hour. Good. Okay, thanks very much. A few more Q&As, which is great. I will obviously come back to those very soon. But thank you very much for asking the questions. It really does make these sessions a lot more useful and meaningful to the current situation. Good. Okay, we'll come back to some more slides now. I'll try not to spend too much time working through content because I do think the question and answer section is probably the most valuable. But I do think it's worth covering some content to give people some food for thought. Okay, so this graph here is from a report titled Buy to Let Comes of Age, and it was done by a research house called Wigglesworth in 2013. So it's a little bit dated, but given that the report was done over an 18-year, the time frame the report is based on was over an 18-year period, I do very much think it's still very relevant. So what it looked at was the returns on a 25% deposit in a 75% leveraged property. So going back to my same example, the £50,000 into a £200,000 asset, the returns on the cash versus cash bought property, commercial property, shares, gilts, and cash. And what I've added into this, which wasn't part of the report, is the average return on capital from a privately owned, non-financial UK business in the last financial year. So the average from a UK business average return on capital in the UK business is 13% per annum. Okay, so if we look at leveraged property, the average was 16.3% per annum over that 18-year period. Cash bought property 9.7, commercial property, shares, gilts, cash, and then we've got another factor which is return on capital in business, and this is actually deployed capital, not cash sitting in the bank, because obviously cash sitting in the bank for a business, you're generally getting 1% if you're lucky, but this is cash actually invested in the business according to the Office of National Statistics. So what's very interesting about that is a relatively passive leveraged buy-to-let property. The returns on cash are substantially better, even on a pretty average return. Remembering we're aiming for 5 to 10% yield, 20% growth. So that puts us at 25 to 30% per annum, which is more than double anything else. But even the very average UK property over that 18-year period, you're at 16.3%. So this was the whole of the UK, so the average across the whole country. So quite interesting that even a very passive investment can give you a very good return. And the main reason for that is the leverage. The fact that essentially you're quadrupling your buying power through the 75% mortgage. Okay, so benefits of buy-to-let for business owners. Now, as I mentioned before, this isn't just for business owners. It's also for employees who have spare resources or are earning good income and want to better utilise it. But for some of them are specific to business owners in that keeping funds in a tax-effective vehicle. So if you have spare funds in a business that is sort of sitting there, you're not quite sure what to do with it. Obviously, one option is to pay it out of the business to yourself, but then you pay a lot of tax on it. The company tax rate within a company is, well, obviously the company tax rate within a company is 19%, which is better than anyone's personal tax position. So keeping it within that structure is useful. And what you can do is you can set up a special purpose vehicle which runs alongside your business and lend the money across to invest in property, meaning that any cash left in your business can be invested in property without having to take it out of the company structure and pay tax on it. So that's what I mentioned. You loan the funds across to the special purpose vehicle that you also own. Often a better return than the capital in your main business. This is a very common strategy, is building a property portfolio alongside your main business. And quite often it can get to the point where the property business becomes much more profitable than your main business. And that's okay. Because generally that's the end goal anyway, that we want our property investment income to replace our employment income at some point in the future. And obviously it depends on how profitable you are and how much spare resources you have available as to how quickly you can do that. Obviously it allows you to control the release of funds from the company structures. The benefits of leverage. I'll just skip back because a couple of people are commenting here. Okay, guys. So Matt, if you don't mind just putting that question that you've just asked into the Q&A section rather than the chat section. The Q&A section allows me to come back to it and answer it specifically toward the end. Whereas with the chat section, if some other people start commenting, your question will disappear. So if you don't mind just copying that over, and then I can come back to it shortly. Right. Obviously, the benefits of leverage. So, having cash sitting there in a business, even if it is invested in business activities, you're rarely getting the benefits of leverage, which goes back to what I mentioned before. Average returns on the asset value, giving really good returns on your cash. The ability to hedge against business risk because you have a separate business that's invested in property. For example, if I own a laundrette and people stop using laundrettes, which they probably will at some point in the future, perhaps, I've got my property business as well. And the ability to create passive income from proactive profit. And that's the key point here, is I meet with far too many people that go through their whole life earning good money, whether that be as a business owner or an employee, and all they do is improve their lifestyle. And they spend that money, or they wait and wait and wait for the best possible time to invest, and are constantly looking for reasons not to invest because they can't quite get the confidence to do it. The point here is we want to be taking as much spare resource as we can and putting it into tangible assets that are going to grow in value and generate income, because that's the best way of securing our financial future. All right, I think I'll skip out to a PDF now rather than looking at that slide. So this is actually an extract from my book. For those of you who aren't aware, my book is The Property Pension Plan. It's now an international bestseller in the UK and Australia. I'll show you where you can get it for free in a moment, but this is an extract from the book. And what it looks at is essentially a forecast so far as how to build a property portfolio using relatively average drivers. So the drivers, so it uses the example of buying one £200,000 property to start with on a 5% annual growth rate and remortgaging every time you create 25% equity in that asset. So the 5% has a compounding return every year that the property grows in value. And we'll just quickly run through these numbers because I know that numbers aren't for some people, but they are for others. So £200,000 property, £150,000 debt, meaning a 75% loan to value. Now, as the asset value grows 5% per annum, what you'll notice is that the loan to value comes down on that property. What we've also accounted for is a 2.5% net yield. So again, very, very achievable, and also reapplying that 2.5% net yield to the debt, which unless you've got a better use for that money, for example, taking an extra holiday a year probably isn't a very good use of that money. Your investment returns should probably be reinvested. And what that does is helps you bring down the loan to value even further. And here you can see that if you were to bring the loan to value back up to 75%, how much funds would be accessible. Okay, so we'll flick to the next page. And what you can see here is how often using that strategy, and this is about applying £50,000 initially and then not applying any further cash, just the growth and the net yields from the asset. And you can see how quickly this person is able to acquire a portfolio property. So starting with one in year one, and by year 5, using that same strategy, you have 3. Ooh, sorry. By year 10, you have 4. By year 15, you have 8. By year 20, you have 16. And by year 25, which obviously is a long time, but if you're starting out in your 30s, very, very achievable. By year 25, you have 32 properties. If we go back to, these figures, this shows you how you get there. So by bringing down the debt, using the net rental income, which brings the debt down like this, and the equity increasing like that, has a kind of a dual effect on the creation of equity, and then remortgaging and reinvesting that money. Now, I know what I've said there perhaps might be slightly complicated. Still seeing, oh right, sorry guys. Still seeing the PowerPoint. 1 second. I will have to go through that again. Okay. Now, I'm going to skip back. I'm on a PDF now, which shows some numbers. Can everybody see those numbers? I'm just going to skip back. Can everybody see those numbers just now? Yep. Okay, great. I'll just go through those again quickly because I'm sure you heard what I said, but you didn't see what I was showing. So what this shows is £50,000 invested into a £200,000 property on a 5% annual growth and a 2.5% net yield. So after all expenses, we're putting the 2.5% net into reducing the debt every year, and we've got the 5% value increasing. So we've got an upward curve on the value, we've got a downward curve on the debt. Okay, and now here you can see how the growth reduces the loan to value. Here you can see how the debt being reduced decreases the loan to value, and how the equity is being created in the properties. Okay, now down here we have the explanation of the snowball effect. So you can see in the first year they start out with one property. By the 5th year, they've got 3 properties. By the 10th year, they've got 4. 15th year, they've got 8. The 20th year, there is 16. And the 25th year, there is 32. And you can also see here the income being generated from those properties as well. So by the 10th year, it's generating £76,800, £153,000 in the 15th, £300,000 in the 20th, and £600,000 in the 25th. And then we can see the asset values as well, increasing to beyond $1 million, nearly $2 million by the 10th year. Now, if I was to say to you that I can help you turn £50,000 into over £1 million over a 10-year period, that might seem unrealistic. Well, what you can see here is by investing in the right properties that are growing at a relatively average rate, by being able to remortgage and reinvest the equity created, actually, that is quite achievable. So that's quite interesting. Did everybody get that this time? As far as it's actually being able to see the numbers. Yeah, excellent. Thanks, guys. Thank you. Okay, we'll go back to the PowerPoint. There's not too much more content to go through, but I think what is there is useful. Okay, so what type of property is most suitable for passively growing your portfolio? The most passive types of property, in our view, are new properties. The reason that the most passive properties are new is they come with a broad range of warranties. So you'll have a 2-year builder's defect period from the start, which covers all minor defects, An example of this is, I bought a new build flat in London about a year ago. A few weeks ago, one of the mechanisms on the windows stopped working. I submitted a defect report. It was fixed a couple of days later without any headaches to me or any cost to me. Now, as a landlord, that's very valuable, because generally if something is going to go wrong, it will go wrong in the first couple of years, and it becomes the developer or the main contractor's issue, not yours. Also, all of your fixtures and fittings are under warranty as well. So things like your oven, your dishwasher, your fridge, you'll have a manufacturer's warranty on those. And you have a 10-year structural warranty, which covers the structure of the building, design defects, water ingress, etc. So it results in a much lower maintenance, lower cost property. But if we are looking at new or off-plan properties, you get to pick and choose the best of, well, if you get in at the right time, or if you deal with a company like us that has buying power, we can pick and choose the best of what's available. When buying second-hand properties, you're kind of just getting what so happens to be available at that point in time. Whereas when it's new and we can see the whole price list, all of the layouts, we can pick the best of what's there. And sometimes there's a bit of sort of pricing arbitrage there where developers can misprice properties and we can get the best of what's there for the same price as, the worst of what's there, for example. And these are the types of things that we aim for. we aim to position our clients in the best possible way to achieve the best possible outcomes. What is your current situation and what's most suitable? Well, if you're a beginner or if you don't yet have a large asset base, then growing your asset base is most important. An analogy I sometimes use for this is it's like growing an orange and squeezing an orange. If you've got a tiny little orange, there's not much point squeezing it because you're not going to get all that much juice. If you've got a nice big orange, then squeezing it is worthwhile because there's enough juice in it. And the same applies to an investable asset base. If you've got a large investable asset base and you want to retire tomorrow, then focusing solely on income is okay because you're going to be able to generate enough income to live comfortably. Whereas you've got a small asset base, let's say a first-time investor with £50,000 to invest, but your end goal is £50,000 per annum. Well, there's no point investing just for income now because you need to grow that asset base to generate enough income. Hopefully that makes sense. And understanding what your end goal is very important. Now, this is different for everyone. I put an example here because I'd say of the couples we meet with, the average passive income goal, or even a sort of minimum passive income goal that they require to live comfortably is about £50,000 to £60,000 per annum. Now, that's fine for some people, but others wouldn't spend that in 2 or 3 years, and others would spend it in a weekend. So, it very much depends on your personal lifestyle or what you want your lifestyle to be. But let's use this as the example. If your goal is £50,000 per annum, you'd want to have an investable asset base of at least £1 million. Now that excludes your home. It's just funds that are able to be invested. And that's based upon a 5% net yield. The reason we use a 5% net yield is that that's generally quite achievable, regardless of the state of the economy or the political cycle or anything like that. We're pretty confident in being able to get that. What you might say to me is, well, Paul, I can get a 10% net yield. And that's great, but you may not be able to get that in 5, 10, 15, 20 years, whereas you should still be able to get 5. So you want to be pretty conservative with these things. So if you can get a 5% net yield, we need £1 million to generate a £50,000 of passive income. And this is without eating into your asset base, remember, because we don't really want to be doing that. Everybody's living longer these days. So ideally what we want to be doing is living off the proceeds of our asset base rather than eating into it. Now, if you want to work this out for your personal passive income goal, what you need to do is work out that figure. What is the end goal? For example, how much do you need on a monthly basis to live comfortably? Times that by 12, that gives you your yearly passive income requirement. Divide that by the achievable net yield. So in this case, 5%. So you divide it by 0.05, and that will give you your investable asset base. Or, an easier way is double it and add a 0. So if the goal is 100 grand, double it to 200 grand and add a 0, which is 2 million. If the goal's, 20 grand, double it to 40 grand, add a 0, gives you 400 grand. Now, the number of properties doesn't really matter. I get asked this question all the time. How many properties do I need? What's the end goal of how many properties I need? It doesn't matter because there's a huge difference between having 10 £100,000 properties and having 5 £1 million properties, or having 10 £100,000 properties with 50% leverage, or having them cash bought. It's all about the equity in the properties and the type of return that you're getting and whether that's suitable for you and your goals. Generally, when people are growing their asset base, they focus on growth. And then perhaps when they get toward having the asset base they need, they probably aren't quite generating the income that they'd want from that asset base. So, excuse me, so there needs to be a bit of a shift in focus there. Vice versa, if you already have the asset base that you need, and it is giving you what you need, great. If it's not, then again, there needs to be a shift toward getting more income from it. Okay, so a couple of things I just want to run you through. So first off, why Nova, our experience, awards, testimonials and things. So all of this is on our website. Our website is nova.financial. You'll see at the bottom here a banner which relates to my book, which is this here. As I say, it's an international bestseller in the UK and Australia. So it's been very well received. If you go to this page of our website, simply by clicking here, you can get a free copy of the book. So you just have to pay postage, which is £5. The book is usually £15 on Amazon. So you can get a free copy of that. Or if you prefer listening rather than reading, you can also get a copy of the Audible version. So it's on Amazon Audible, where you can listen to the book, an audio version. Or you can also get a Kindle version on Amazon as well, which isn't here, but it's on Amazon. We have about 100 hours of video content on our website, which can be accessed here. I host a couple of TV shows, which are all on Sky. We've won lots of awards, which I think I've got here somewhere. Yep, won plenty of awards. So we've very much established ourselves as the industry leaders in what we do, which is nice. Actually, I think maybe you can still see that. Yeah, you can. Sorry, guys, I've made the same mistake again. Okay, sorry about that. I believe you could probably still just see the PowerPoint there, but hopefully now you can see our website. Yep. So here's the access to the book. So nova.financial is our website. You can access the free book here. That will take you to this page. Plug in your details and pay for postage, and we'll get a free copy out to you. We've won lots of awards, so we've very much established ourselves as the industry leaders in what we do. So just back to that, if you want the Audible version, you can access that there, which will just take you to the Audible page. I believe you can get a 30-day free trial, so you can also listen to that for free. Our management team. So as I say, in our management team, we've got 4 qualified financial advisors, over 100 years of experience. We're all property investors and investors in general ourselves. So hopefully we know a thing or two about what we're doing. Oh. Okay, so that's probably enough about us for a bit. We've also got very positive video and written testimonials across all of the platforms. So just before we get into the question and answer, I mentioned before that we'll be offering free face-to-face consultations, which given the current scenario will be via video conference. Now that's to establish if there is a fit between what we offer and what you're looking for. We'll take you through in detail what we do, and then we'll look at your situation in detail as well. If there is a fit there, we usually charge a fee, which ranges between £500 and £2,500, depending on the complexity of what we're doing for you. The promotion that we're running is we're offering to waive that fee. So we won't engage with everyone because there's no point wasting anyone's time. But if there is a fit there, then we'll engage with you. We'll generate our advice on how to improve your situation completely free of charge. So if you would like to access that promotion or at least discuss it briefly over the phone, we will be sending a follow-up email to the webinar. So feel free just to reply to that email and we can organize a time either on the phone or via video conference to discuss how we might be able to help. Okay, good. Now, on to the fun part, questions and answers. So if any of you do have any more questions and answers, please plug them in here. We currently have 13 of them. So I'll work through each of them individually and hopefully add enough value to everybody that's listening. Great. So first off, first question. I won't name people because some people may not want to be named, but I'll just rattle off the question and then I'll give you an answer. So what is the best way to start investing in property if you have a 20% help to buy loan, one that is interest-free for 5 years, but means you can only own one property? My current mortgage is about 20% loan to value, excluding that. So should I pay off the help to buy before investing? Okay, so good question. So yes, technically, when you have help to buy, you can't own other property. However, one way some people are getting around this is by investing through limited companies. Because if you buy a buy-to-let through a limited company, you do not technically own it. The limited company does. And, you know, I'm not an expert in help to buy, but everything that I've seen to date from both lenders and others is that they are perfectly fine with that. Because it's not you personally that's owning the buy-to-let, it's the limited company that you own. So that's one way around your situation if you did want to start investing in buy-to-let now. But in saying that, I suppose it first off depends how long you've had the Help to Buy loan for, because I believe it is pretty well interest-free for 5 years. But of course, it is an equity loan. So if the value of your property is increasing, then they are also increasing their equity in your property. So probably an assessment there on the cost versus benefit as to whether you can pay it, whether you should pay it off. I believe that you get 3 attempts at paying off Help to Buy equity loans throughout the 10-year period. And if you've only got 20% owing other than that, so you've got therefore 40%, at least 40% equity, and it depends on whether you're in London or not. If you're in London, probably 40%. If you're outside of London, you've got 60%. So there's quite a lot of equity there in your property. So maybe accessing some of that equity would be a good idea too, or getting rid of the Help to Buy portion so that you can just start working toward, owning your home outright, which isn't a bad thing, but also not a bad thing to remortgage your home to use the equity to invest in the right circumstances. So hopefully that answers that question well enough. If I don't quite answer anyone's question well enough, feel free to let me know. And I'm happy to cover anything that's still outstanding, whether you can do that perhaps in the chat section. But James said thank you, so I'm assuming that was useful. Good, okay, so next question. Hi Paul, where do you see the property market going after COVID-19 crisis is over? I know there is a lot of doom and gloom, but is this likely to be a short-term thing, with this actually being a great time to invest? I think the saying is, when there is blood in the streets, there is money to be made. Is this true of this case? Okay, so I think you're taking the right attitude in that, yes, there will be an economic impact of all of this, but I think anybody who tells you that they know what that is, or that they know what direction the market is going in, is either guessing or worse, lying, because nobody knows. What we can do is we can invest in the right properties in the right locations that are going to perform well regardless of the economic cycle. And in my opinion, those properties are centrally located, desirable properties in major cities and employment and infrastructure hubs, because in those areas are a lot more sustainable than more regional areas, for example, because you have the most reason for people to want or need to live there. And that's what we want. We want to tick as many of the boxes as we can, so far as what renters look for and so far as what future buyers are going to look for. And if we've got an abundance of reasons for people to want our properties, then there's still going to be demand for them over and above the competition. Now, if you own those types of properties, you can be quite confident that you're still going to have a tenant regardless of the economic cycle, which obviously is, well, perhaps not so obviously, but is the most important thing when it comes to leveraged property, because if you've got a tenant, you're safe. It doesn't so much matter what happens to the value of your property in the short term, because the market is cyclical. And we know if we've got a good property in the right location with the right fundamentals to create growth, then we're going to do well over the mid to long term. And it's not so much about being worried about what's happening in the short term. Something that I quite often say is that there is that property investment is not about time in the market, but rather time in the market. Because very, very few people, if anyone, can accurately pick the direction the market's going in. And in fact, if we look at history, we can confidently say that the media and the masses, popular opinion, is almost always wrong. Using the last financial crisis, for example, is if you looked at just before the last financial crisis in 2007, 2008, everybody was saying it was the best possible time to buy. Property was never going to fall in value. Why wouldn't you buy property? You're mad if you don't. And actually, it was the worst time to buy because it was just before the market turned. If we then go a few years later, 2009, 2010, 2011, everyone was depressed. Why would you buy property now? It's just crashed. It's the worst time to buy. And actually, it was the best time to buy because you would have got it right at the bottom. So that saying of when there's blood in the streets, there's money to be made is relatively true, in that, you know, if you go against popular opinion and make savvy investments, you can be pretty confident in doing well. So my opinion, I'm still buying property. I'm going through the process of buying. I've literally just exchanged on a buy-to-let in Manchester. I'm going through the process of buying another one in Liverpool at this very point in time. So I think it's still a good time to be buying in the right circumstance if it's the right properties in the right locations. And I you know, obviously don't really know what the economic fallout of all this is going to be, but I do hope it's short-lived. But even if it's not, it will be relatively short-lived. Even if it's a year or two of bad times, if we've bought good properties that are still going to rent, it doesn't really matter. Okay, next question. Where do you see the mortgage situation going in the short and medium term? Okay, so mortgage situation in the short term. A lot of lenders have paused mortgages at the moment. A big part of that is that they're in a similar situation to the rest of us. You know, that their workforce is working at home. They're also getting inundated with inquiries around mortgage holidays. So that's taking up a lot of their time, and they're unable to do valuations. So it's I think some of the media articles recently have sort of skewed this toward being a negative thing, but it's perfectly understandable as to why a lot of lenders have sort of paused new mortgage applications and aren't processing new mortgage applications because of those reasons. In the medium term, I think very little impact. Once we are able to stop working from home and once we get some form of normality back, I think everything will return to normal in the mortgage market as well. Okay. Sure you'll cover it, but curious. Okay, sure we cover it, but I'm curious to know how your organization makes money from this. Okay, yeah, very good question. How do we make money? So the way we make money is very much mutually beneficial to our clients, in that we only make money when we do something to help our clients improve their situation. So what I mean by that is, as I said, first off, we usually do charge an engagement fee, but that's not about making money. That's to ensure the client is going to value the time that we put into a recommendation, because on average, we put about 10 hours work into each initial recommendation we make to our clients. And that's what we're offering for free now. But that's more value-based. Where we actually make money is if we source a property for you and you purchase that through us, we would generally be able to collect a fee from the vendor, the same way as an estate agent would, but it's fully disclosed and transparent to you. We generally will always get you a better deal than what you would get going direct. But of course, because we've got that buying power, people want us to be recommending their properties, and they will pay us a fee for delivering a buyer and facilitating a sale. We also have a mortgage brokerage, so we make money the same way as any other mortgage broker would. There's some initial fees and then a commission on product arrangement, and we do property management. So if we manage a property for you, there's a fee for us there as well. So it's very much mutually beneficial so far as the services that most of our clients require. We try not to have to charge them exorbitant fees, but collect those fees by doing something in helping you making a decision. So hopefully that answers that one for you. I'm obviously happy to go into that in a lot more detail on a sort of face-to-face basis. Property investment versus the share market. Discuss. Okay. So I have shares and I have property, but my strong preference is leveraged property. Now, the reason my strong preference is leveraged property, it goes back to the figures I mentioned before. So the fact that I can take 50 grand, buy a £200,000 property and be pretty confident in getting very strong double-digit returns whilst just tracking the average on the market means that I can have an extra level of confidence in getting those returns. Now, so far as I'm aware, there aren't an awful lot of shares or trusts or share funds that will enable me to get 20% plus returns with confidence without taking too much risk. Some funds do give those returns, but they give them 1 year and then they return nothing the next, quite often. Or they disappear overnight And that's the major thing with shares as well. Even the biggest companies can disappear overnight. So there is more inherent risk. It makes much less sense to borrow to invest in shares because the borrowing costs are high and the yields are low. Whereas, property as a cash buy is relatively similar to shares returns wise, but the leverage is a game changer. That's what makes property so attractive, is the ability for leverage. And in my opinion, there's nothing that really competes with leverage property on a risk versus return, and also a sort of confidence in return basis. So in short, that's my comparison of the two. Obviously, share prices are down at the moment, but the concern is they could, if we do have a recession or worse, that they keep going down and that you lose your money. Whereas if you buy a tangible asset in a desirable location, you're still going to have a tenant regardless of a recession. And therefore you're still getting returns. You're able to sustain your investment. You're not going to lose it. Okay, next question. Will I buy as an individual or a company? Okay, so obviously a hot topic at the moment. Lots of people are buying through limited companies. The main reason that's become popular is because of Section 24. So the changes with regards to buy-to-let mortgage interest, changes with regards to buy-to-let mortgage and the tax deductibility of them. So to give you some figures on that, before Section 24 was announced, only 5% of new buy-to-let mortgages were for limited companies. And in the final quarter of last year, about 70% were. So a massive spike. Now, most people are buying new properties through limited companies. This depends on your situation as to whether it's suitable or not. Usually, the threshold for where it makes sense to consider investing through a limited company is if you're a higher rate taxpayer. So if your income is higher than £50,000 per annum, if it's not, if your income plus your property income is less than 50 grand, it doesn't make much sense at all to invest through a limited company for tax purposes, because you're not affected by Section 24 if you're a basic rate taxpayer. Another way around that is quite often we work with couples and one person will be on a high income and the other is on a low income. If that's the case, you can divert property income to if you're married, to your partner's name, and sometimes avoid Section 24 altogether as well. So the point here is you need to get personal advice. It's something we can help you with better understanding as to whether you should be buying in your own name or you should be buying through a company. Okay, lots of questions, guys. This is great. Next question. I have a buy-to-let flat, which I purchased with a 25% deposit, a 75% mortgage, and therefore my monthly mortgage repayments are significant. I'm therefore finding that my tax bill is wiping out any yield from profit I'm making. I'm therefore relying on capital gains for a return. Is this a common situation your clients are finding themselves in? Look, I think this very much depends on what property you've bought and the yield that property is generating. Because part of this Section 24 I was referring to, part of the impact that's having is more of a focus on having a larger yield buffer and making that more important. If you're investing in a higher yielding property, you wouldn't be having this problem. But if it's a lower yielding property and you've bought in your own name and you're a higher rate taxpayer, then that your tax bill increasing through Section 24 may well get you down to a close to a neutral cash flow position, and therefore having to rely on capital gains. It's something that a lot of people in London and the Southeast are experiencing, but not so much in other areas. We have been focusing mostly on Birmingham, Manchester and Liverpool as our predominant areas of investment over the past few years, because we can get properties at a lower entry price and a higher yield, but still be in major cities and infrastructure hubs. So it's a common problem that a lot of people are experiencing, but not so much our clients. Okay, next question. So what tax efficient property investment solutions are there for non-UK domiciled individuals living in Hong Kong, Australia or Canada? Okay, so it's important for me to point out, guys, I'm not a tax specialist. I'm not an accountant, but I'm happy to answer these questions in a general sense, so far as my understanding. Tax efficient property investment solutions. I assume you're talking about investing in the UK. You've said for non-UK domiciled people. So far as I understand, overseas investors in the UK pay 20% tax in the UK. Okay, so that's quite a tax efficient way of investing anyway. I know that some overseas investors do invest through limited companies. Now, part of this will be dependent on whether you are an expat, meaning that you're from the UK, or whether you're just an overseas, so you're from elsewhere, for example, Hong Kong, Australia, or Canada. You're from those countries, but you want to invest in the UK. If you've got a complex tax position, it's definitely worth seeking personal tax advice. But so far as I understand, as an overseas buyer, you pay 20% tax in the UK on your net property income, and therefore that's quite a tax efficient investment in any case. So I'm not quite sure how you would make that more tax efficient unless you had a more complex tax position. Next question. Would it be wiser then to invest £50,000 into a £200,000 property than buying a lower value property, say 75K outright? Look, the answer to this question depends on your situation, but in a general sense, I would say yes, and almost absolutely yes to most people, because the reality is in the UK, in my opinion, there's not an awful lot worth buying valued at £75,000. There are lots of properties out there that are valued at £75,000. It depends where you are in the UK, obviously, but as I said, our main focus is being in major cities, central locations, desirable property, because all of those things mitigate risk. There is safety in that type of property, and therefore leveraging your money, and remembering this is cheap money. We can borrow at the moment a 75% mortgage at sort of 2 to 3%. And then we can get much better return than that 2 to 3% cost, and therefore it makes sense to have it. So in general, I would say yes. You're better off taking the leverage because you will get, almost definitely, get better returns on the cash invested. Okay, next question. Your analysis is based on increasing property values. What happens in declining negative equity environment? Okay, so it's a good question. However, it's important to keep in mind that if you're investing in properties that are ticking those fundamental boxes that I mentioned, although there might be short-term declining negative equity environments, they are relatively short-term. Historically, they only last for 1 to 3 years. So that because the market's cyclical, but it generally, hopefully you can see my hand here, generally the market will kind of go like this. You'll get a spike in prices, you get a plateau, you get a little fall, then you get a plateau again, and you get another increase. Historically, that's how property prices have worked. So if we're investing for the mid to long term, we can be confident that prices will increase if we bought the right properties in the right locations. So, you know, so long as you're confident your property will rent, even in a downward market, that's the most important thing. So long as we are confident the properties in those areas will increase over the mid to long term based upon things like population growth, infrastructure spending, gentrification, all of the things that are a catalyst for change. Okay, next question. With regards to the snowball effect spreadsheet, you showed us the numbers and principle make total sense. However, what mortgage rate was this worked out on? And what if the interest rate skyrockets in years to come, i.e. in the 90s when it was double figures? Okay. So this was worked out on a 3.5% interest rate, which is above current rates. So it does have some flexibility there, so far as the cost of your debt. And look, if rates skyrocket, then the scenario changes. It's important to have a strategy, but strategies don't have to be set in stone. They can change as the environment changes. I would be very surprised personally if interest rates skyrocketed anytime soon based upon our current environment. But of course, at some point in the future, they could. And you would just need to change your strategy to adapt to that. It's very difficult to forecast based upon double-digit returns, especially when the Bank of England is stress testing interest rates at 5.5%, meaning that they're essentially saying that that's the realistic rate it might go to within current mortgage terms. So we can only really base it upon the current environment and the direction we see the current environment going in. Okay, so similar question to a previous one, but this is assuming that values of the property goes up. What if it remains similar in value even over a long period? Well, this very much comes down to the locations and the properties that you're buying in. If you can see billions of pounds being spent in the surrounding areas of a location, there's only one way that prices can go based upon that spending. I'll give you a high level of example. I bought 2 properties a few months ago in Digbeth in Birmingham. Now, Digbeth is an area in central Birmingham to the southeast, which is about 30% cheaper than most other central locations in Birmingham. Now, in the close vicinity to that location, you have Smithfield Markets, which is being redeveloped by Lendlease and is a £1.5 billion development. You have the new HS2 railway station, and you have the Commonwealth Games. Billions of pounds being spent over a few years in a relatively small space. That's going to make that area much more desirable and will increase prices, regardless, I would say, of the general direction the property market's going. So if you're investing in areas like that, you can be confident that firstly, prices won't stay flat, in my opinion, for a long period of time. But even if they did, if you're generating a net yield, then you're at least getting some return. Keeping in mind that property prices don't increase for no reason. There has to be a catalyst for that change. So if you're investing in your local town just because it's around the corner from home, but there's nothing really positive happening there, then yes, maybe they do stay flat for a long time. But if we have an investor's mindset and we're unemotional, commercially minded, and we're investing in areas for growth for the right reasons, then I'd be confident that won't happen. Okay, a bit more of a personal question, this one. If you've been really successful, which it sounds like you have been, what is your motivation to continue? Look, at the end of the day, I have been reasonably successful, but I think my motivation to continue is I don't think I will ever be content. At the end of the day, I want my family and my children and my children's children and my children's children to be as comfortable as possible. I suppose you could ask this question of any successful person. And look, I wouldn't put myself in the category of being super successful. I'm not a billionaire, but that's something to aim for. So at the end of the day, I wouldn't say that, I'm not like some of these sort of talkers out there that say I do it just for you guys because I want you guys to be millionaires. I love helping clients and I love helping clients be successful, but I like it to be mutually beneficial as well. So my motivation to continue is that, we can always do better, I suppose. I'm also relatively young, guys. I'm only 32. And I've got a big property portfolio. I've got lots of successful businesses. So maybe that's a good question to ask people that are in their 50s and 60s that probably should be sitting in a beach in Mexico. But I'm pretty happy to continue generating success for quite a few years yet. All right, next question. Sorry, you don't have to apologize for asking questions. That's what we're here for. Would you advise taking equity out of your personal home to boost your investment pot? Look, this is a very common question. And I think a lot of people get very worried about remortgaging their home to invest. But what's important to keep in mind is regardless of where your debt is secured, so whether that be against your home, your investment properties or something else, if you default on that debt, the lender can come after your assets regardless of what they are. So it's not just about where that debt is secured, because by personally borrowing, you effectively are giving a personal guarantee. So regardless of where your debt's secured, you're taking that risk anyway. So if, for example, the majority of your wealth is tied up in the equity of your home, then and you aren't yet on track to achieve your goals, and you probably do need to use that equity to help you get there, then I would say yes. Accessing that equity and investing it sensibly, prudently, is a good idea. But you want to make sure that you've got the financial position, income-wise, and that sort of thing to support that. So yes, it can be a good idea. Anybody that tells you it's a bad idea, I think, is pretty sort of one side in their opinion. I think one of the biggest mistakes that I see people make is plowing all of their money and all of their wealth into their home, because it's no use having a really expensive debt-free home when you're 60 if you've got no investments. You won't have the ability to live comfortably. You might have to sell that home that you've taken so much pride in. So accessing some of that equity to build a portfolio can be a good idea. Okay, next question. What are the pros and cons of buying a property through a limited company? How would the council tax rates be affected if it was unoccupied, for example? Okay, so I have already answered this question so far as the pros and cons associated with buying through a limited company, or why you would do it. I can expand slightly on that. One of the pros of buying through a limited company, if you're a higher rate taxpayer, is you avoid Section 24. So your mortgage interest remains tax deductible. Also, you can lend the money into the company as a director's loan into the company and pay that money back to yourself tax-free at any point in the future, given that you've already taken taxed money and put it into the company. Companies are also a lot more flexible than in your own name. You can control the release of profits and potentially run a few more expenses than you'd be able to in your own name through the company. Cons is the money is trapped in the company. So the company strategy works well for people with a long-term strategy that don't want to retire tomorrow. For example, someone that's young that wants to build a portfolio through the company and take the income at some point in the future when they've scaled back their employment income. It's not very tax efficient to start drawing an income from a company when you're earning income elsewhere as a higher rate taxpayer, because you'll be taxed 40% on taking the money out. So far as I understand, council tax rates work exactly the same. So an unoccupied property, the landlord would pay the council tax rates as a company or as an individual. That's my understanding, but again, I'm not an expert on that. Okay, next question. We're getting through them pretty quick. If anybody does have to leave, don't worry. You will get a follow-up email and you will get a chance to either speak with me personally or one of our advisors here at Nova. I think you'll also get the ability to give us some feedback, which obviously we'd appreciate because we are relatively new to this sort of webinar format. Okay, so next question. Do you always advise to invest in single let, or do you look at HMOs as well? We look at all types of properties, and it really just comes down to what's most suitable for the individual. HMOs have been, a bit of a buzzword in the UK property market over the past few years. A lot of areas have become flooded with them. Generally, if we ask people why they're looking at HMOs, the main reason is to boost yield. It's not the only way to boost yield, though. Other things we look at are service accommodation, a short-term accommodation, renting through Airbnb and Booking.com and that sort of thing. That's a good way of boosting yield. And potentially less work, can be more work, can be less work than HMOs. So we look at everything. Really comes down to what works best for the individual based upon the time you have available, your experience, all those sorts of things. Next question. Pros and cons for buying a holiday home versus a residential home. Okay, so probably if the person who asked this question could just help clarify it slightly for me. Do they mean, when I read residential home, I read a place that you are going to live in as an owner-occupier, whereas a holiday home is a place that you might go and spend the weekends or the school holidays at. And those are two things that we don't really advise on. We advise on investing in property as opposed to buying a residential home to live in or a holiday home. But if what you mean is buying a holiday let versus a residential buy-to-let, I can comment on that. The two are, I would say, quite similar so far as the fundamentals you would apply to buying them, because you still want them to grow in value. However, so far as one or the other, so far in the sort of longer term AST 12-month leasing model versus the 1 or 2 nights leasing model, you'd obviously want there to be very strong tourist demand in the holiday model. But usually we find the types of properties we focus on in sort of major city centres work quite well for both, because you have the demand for both types of markets. Okay, next question. Have you experienced any properties Nova has sold that has had negative outcomes for investors? If yes, what is your edge as a firm when selecting new builds? Okay, so obviously we try to position our clients in the best possible way to avoid any negative outcomes. Most of our clients have achieved extremely positive outcomes, or varying levels of positive outcomes. Generally, I would say we haven't had any clients experience major negative outcomes, aside from perhaps developers doing the wrong thing and delaying, or developers delaying developments. Obviously, from our perspective, we try to do as much due diligence as we can to position our clients in the best way possible. But there is always, if someone is buying through a third party, there is always that third party risk of the third party not doing the best possible thing. How we're able to add an edge, I suppose, is getting access to information to allow us to do an extra level of due diligence over and above what an individual would have access to. And then helping our client understand those things, and I suppose the time and level of due diligence that we put in to getting to that point. Right, a fairly simple one: leasehold versus freehold, and what's our preference? Our preference is generally leasehold, and that might surprise some people. It's not because we prefer leasehold over freehold as an individual concept. It's because when we identify the most suitable locations to invest in, for example, central sort of major city locations, and then identify what the most suitable properties for those locations are. For example, if you've got very high single and dual occupancy rates in a location, then 1 or 2 bedroom apartments make the most sense. And generally, 1 or 2 bedroom apartments are leasehold. So if you have the right leasehold agreements in place, for example, the lease being sufficiently long, things like your ground rents not being exorbitantly high, and you're buying from a reputable company that will have structured things in the best possible way. For example, all of the properties I own are flats, and they're all leasehold, and they've all served me quite well. So both can work, I suppose, is the answer. Generally, our preference is leasehold, but not so much because it's leasehold, more so because that's the most suitable type of property for the locations we tend to focus on. Okay, next question. So, hi Paul, I have £120,000 sitting in the bank and I live in London. What areas would you suggest to invest in so I can buy 3 properties? Okay, I'd say first off, try not to focus on the number of properties you can buy. Unless you've got an extremely good reason as to why you need to buy 3 properties, I don't necessarily think it needs to be 3. And I'd go so far as to say that stretching 120,000 across 3 properties would potentially be the wrong thing to do, because you'd be limiting yourself to £40,000 per property, which means you're limiting yourself to a total purchase price of, including costs and things, of probably about £140,000. Now, we probably can get 3 good £140,000 properties, but maybe there's a better property for £200,000, and you don't want to exclude yourself from that just for the sake of getting 3. But predominantly, as I said, the areas we've been focusing on are Birmingham, Manchester, Liverpool, and the right properties in the right locations of those three cities. So more than happy to help you assess those options on a one-to-one basis following the webinar. Okay, this is great, guys. Lots of questions. We're down to our last four. Would you advocate using rental income to pay down the debt on a mortgage balance in order to increase the equity percentage, rather than using the money to place a deposit on another property once you've accumulated enough? Okay, really good question, and a very common question that we get. I would say, generally, use the money to pay down the debt and get the debt down to a point, in combination, hopefully, with the value increasing, where you should be able to remortgage sooner and reinvest to buy your next one. So yes, you could keep the net income in a bank account until it adds up to enough to buy another property, but you're likely to get there a lot sooner by paying the money off the debt, reducing your interest repayments, and therefore increasing the equity in the actual property to remortgage to reinvest. Hopefully that makes sense. Next question. So due to my current skill set and wish to boost my investment pot as quickly as possible, I was thinking of using buy, refurbish, refinance strategy. Could be a good method. Do you offer these kind of properties? So again, we can assist with this strategy. And I suppose you mentioned your current skill set, which is great. The other thing to consider with this type of thing is time and the actual returns that would generate. Because in the right circumstances, that strategy can work really well. But I'd say a lot of the time when we speak with people about that strategy, they assume that it's going to make them a lot more money than investing passively, but that's not always the situation. In that, for example, I would say the average our clients tend to achieve when buying off plan is a 10 to 15% uplift in value. Whereas, and that's over a 12 to 18 month period. Whereas with a buy and refurbish strategy, it's probably about the same uplift that they're hoping to achieve, but it's a lot more work and a lot more risk. So when you compare those two options, passive versus very proactive and a similar return, I know which one I'd be going for. But obviously, if you're generating a much better return than that, then maybe the latter's better if you've got the time and the skill set. So yes, we can help with it. I think it just comes down to how suitable it is for you. Last two questions. Could you advise on service charges for new builds? This worries me slightly. Okay. So I'm not quite sure. I'll try to cover this briefly. So far as actually advising on it, depends on the property itself, but especially with new builds, service charges generally start to increase with older properties because there's more to maintain. So when things like lifts need replacing, the building needs repainting, which is usually sort of 15 years plus, as the property gets a little bit older and needs some attention. Whereas with newer properties, you don't generally have increasing service charges anywhere near as much. And therefore, they tend to be a lot more, you can have more certainty as to what they're going to be. And so long as you've sufficiently accounted for them within your numbers, and the net figure is a figure that you're happy with, then it doesn't really matter what everything in between is, in my opinion, so long as the net figure is a positive one. I think a lot of people do get very caught up about service charges, but I wouldn't worry too much about them so long as the net outcome is positive and the charge is worth paying, because sometimes having things like facilities and amenities within a development adds value, but of course they need to be paid for. Okay, last question, everyone. Vancouver was, until recently, a hotbed of activity for local and overseas investors. Is now the multiple hits of double stamp duties, new vacancy taxes, rental controls, restriction on Airbnb, significant home insurance deductible increases, even for new builds, difficulty of finding tenants and declining property values. If one chooses Birmingham, Manchester and other new major attractive cities, how to safeguard from such similar impacts? Okay. Look, all of the points there that you've said that have negatively impacted Vancouver, but keeping in mind, Vancouver got super expensive super quick. So So I think that's why they brought in some of these things. That's not so much the case in the likes of Birmingham, Manchester, and other major cities. And I wouldn't say so much that they're a new major attraction. They've always been major cities in their own right, but it's all the new infrastructure spending and population growth that they're experiencing that is very positively impacting them over the last sort of 3 or 4 years, and is likely to continue. It's very difficult to protect yourself against potential government legislation, but things like things like double stamp duties and that sort of thing, it isn't something that's being encouraged at all by the government at this point in time. So I take on board your question, but we can only really invest based upon the current environment and what you think might happen in the future. If you think these things are going to happen in those cities, then maybe don't invest there. But I personally don't. So I don't think that's too much of a risk. Okay, last question, everyone. I have a company to look after my 3 properties. What do I need to do to make it legal? Okay. I have started a company to look after my 3 properties. What do I need to do to make it legal? Because I will charge myself for the work that I carried out. What do I need to do to make it? So I think the key point of this question is what you need to do to make it legal. Look, I don't think there's anything against having a company that does maintenance works or manages your properties. Not so sure there's anything that you need to do to make it legal, because it is a separate entity to you. So so long as those fees are justifiable, I don't think there's anything wrong with doing that. It's quite a common strategy. Okay, great. Well, look, 25 questions. That's pretty much double what we had last time, which is great. I hope everyone found lots of value in the webinar today. I know that I think I covered quite a lot. So I hope you found it good. Everybody will receive a follow-up email and also the ability to leave feedback on the webinar. So please get back in touch with us if you think there's any ways in which we might be able to help. We're running these webinars every Wednesday over the coming weeks, and we will be changing the topic each time. So if you'd like to come back next week, then feel free to do so. Thank you very much for your time. I'm going to end the webinar now. And look, I hope to meet you at some point in the future, and best of luck with everything. Thanks, guys.